We are doing our annual end of the year real estate recap, and more importantly, looking into the future, what's going to happen in 2025. As always, I'm joined by Josh from Neo Home Loans, great partner of FitBooks. Yeah, it's 2024. It was a little up and down. Let's go ahead and start there because before we really talk about 2025, I do want to touch on 2024 just so that way people understand, what's happened so they can kind of start predicting what's going to happen in the future, as well as, you may just be starting your housing journey and starting to look into it to buy for next year. So you might not have any feel for what's been going on in the market. So Josh, we'll start there first and foremost. Welcome back to the show. Hope you had a great Thanksgiving and how's everything?
Everything's great, man. It's great to be with you. Thank you for having us, Joe. It's always a pleasure to be with the FitBucks community. And you really kind of started exactly where I wanted to start, which is how in the world did we not see? This is the question I keep asking myself. Like, how in the world did we not see a 10% correction nationwide? Because of course there were a few areas that had contraction, but most areas saw higher prices for homes across 2024. How is that possible when we were experiencing 7 and 8% mortgage rates over the last year? That's the question that I think is really perplexing. Like if you would have said back up 2 years ago when rates were 3%, if you'd have said, "Hey Josh, what do you think will happen to home prices if rates go to 8%?" I would have said, "Oh." We'll probably see a 10% correction. But let me share. We're gonna jump into a bunch of slides here. We've got so much to cover as always, Joe. And feel free to stop me with questions. But I get a lot of my data from Redfin. And the reason why I like Redfin, Joe, is that they have data that is 2 months ahead of Case-Shiller. So in other words, they already have their October housing report out with their appreciation rates. And if you're looking at Case-Shiller, you're still looking at August's data, right? And we know that we saw an increase in rates in September. And so I love the Redfin for that reason. It's real time. It's as real time as it gets in the real estate game. And here was the headline: U.S. home prices rise 0.5% in October, marking a year of consistent growth. If we go down and read the subheadline, we can really get everything that's in the report. Home prices grew 0.5%. It was the 12th consecutive month with price growth, meaning home prices went up between 0.2 and 0.7%. On a year-over-year basis, home prices rose 5.9%, meaning compared to the similar to October of 2023, you saw 5.9% appreciation, which is the smallest annual increase since December. So the pace of appreciation is slowing, and we would expect that because we saw interest rates spike. And 8 of the 50 most populous U.S. metros recorded a drop in home prices month over month. So it's not like the entire country saw appreciation. 8 of the 50 did see a price drop. I actually have another page pulled up here. I'll try and draw up real quick. Do you see my page just change there, Joe? Am I sharing? Okay,
Yep.
cool.
Yeah, we can see it.
So the numbers I just talked about were national numbers, right? If you take every market metro in the country and you average it, that was the average. But as you know, real estate is very local. And I'll try to make this a little bigger, Joe. So, in Austin, Texas, which is your metro area, I believe, Joe,
Yep.
your year over year is down 3.37%. And that's kind of a consistent theme. If you look at the areas that were the hottest in 2020, 2021, and 2022, they seem to be the coldest in 2023 and 2024 because those markets got a little ahead of themselves. Like since 2017, my guess is that Austin has pretty much doubled in home price. And a lot of other metros may only be up 50, 60%. So the hottest metros are slowing down. The less appreciating metros over the last 5 to 7 years, those are starting to heat up. But you can see this means that for Chicago, Illinois, in other words, showed 13.58% increase year over year. That's pretty incredible. And you'll see here the biggest decline was San Antonio, followed by Tampa and Miami. And of course, you've got Austin in there. Well, those were the fastest appreciating markets over the previous few years. So I keep kind of asking myself, how is it possible? And let me minimize this and let's go back to the slide deck quick. How is it possible that that home prices didn't go down more? Joe, let me give you space to jump in here, and then I'll kind of move on to the next slide. Is there anything you want to add to that?
Yeah, like you hit on a very good point about it being local versus national. I'm going to talk about that on two fronts for our listeners. First of all, I'll give you an example. Like you brought up Austin, Texas. Okay. I live about 20 minutes outside of Austin. I, we live on the side where Tesla built their headquarters 5 minutes from us. Samsung is building like a $18 billion facility 10 minutes north of us. Amazon built like the biggest distribution center, a mile from my house. It's like the biggest in the country. And housing prices where I live at is, again, I live about 20, 25 minutes from downtown Austin. They shot up huge. And in October of 2022, I believe it was, November 2022, when rates had started increasing, like I did what I call a back of the napkin valuation on real estate, like for my specific area. And I
Yep.
said that based on that, prices would drop between 20 and 30%. And they did. Like they in my area, they did drop 20 or 30%. However, for example, I have another house in San Jose, California, where it's gone up about with those national averages that you've seen. And here, like again in Austin, like there's places that are empty for rent and everything. Like it's not a good market right now in real estate here in Austin. But the reason why I want to bring that up is because you as an individual have to say, what am I am I doing this for? If it's for like a personal residence, you really got to look at that local market. If you are saying, look, I'm looking at investments, then when you're looking at like a real estate investment trust that you're looking at, it's like, where are their properties? Are they concentrated in one regional area? Are they diversified out across the country? That's extremely important because like if I was holding real estate as part of my portfolio, like we have REITs in some of our portfolios we do for our investment services,
Mhm.
they have to be basically diversified. Those REITs went up last year.
Mhm.
Whereas if you had one that was non-diversified, they go down, like because they're in certain areas.
Mhm.
Um, and not only that, but a lot of people, again, 2 years ago, like you said, if rates went up, what would happen with real estate? A few years ago, like 2 years ago, 3 years ago, I had mentioned when people were freaking out because housing prices went up so much. I said you still want to buy property, not necessarily single family stuff, but like just investment stuff. And people are like, why? I'm like, well, land is has always been a natural inflation hedge.
Yes.
And so that's the big reason, in my opinion, that real estate has gone up nationwide is because inflation was going up. Well, when inflation goes up, naturally land is a commodity. And where we saw, I don't know if you have data on this, but where I did a quick just search a few weeks ago where we saw very good increases that I just saw real quickly over the last year was in areas where the land value as a percentage of the value of the total property
Mm.
was higher percentage versus the developed piece. So those of you that don't understand what that is, like if I own a house and it's valued at $500,000, there's actually two components of the value. There's a land component and there's an improvement component.
Yes.
And so that's just something that's like a side note. I don't know if you have any data on that, but where I was going with that point again is know what your purpose is for the real estate. Like we talk a lot on these podcasts about it from a personal buying standpoint, but I also want you guys to learn this lesson from an investment standpoint as well in terms of diversifying out your portfolio. So
Great
I know
point.
that was a long little rant there. I'll let you go ahead and dive into that, add any comments, and I know you said you had another slide to show on that, Josh. So go ahead and jump on in.
Yeah, and I love that land to value ratio. I don't track that, but I do think based on what you just said, it is definitely something to look at. The other thing that is interesting, especially if you're looking from an investment standpoint, is your rent to price ratio. And you can just Google these things. There's reports online, but like for example, when I looked at this last, San Francisco was the worst. Lowest rent, highest price, right? So it had the
Mhm.
lowest rent to price ratio. Other areas like Georgia, Alabama, those areas that are still appreciating very well in 2024, they had high rents comparative to the price of the property. So you can Google those things and get some insights as well. I agree with you that the real estate is one of the best inflation hedges out there. And you touched on something that I wanted to touch on in this presentation, which is if let's go into the auspices that this is for a primary residence. Why do people want to own a home? And I found this pretty interesting. And again, this is just my kind of fascination or search to try to understand how is it possible that mortgage rates go from 3% to 8%, low of around 3, high of about 8, and we didn't see a national 10% home price correction, which is what I would have expected. And so I keep looking for insights to kind of understand why that is. And I found this one pretty interesting. This came from LendingTree. It was a survey of potential buyers, and it helps me just it just helps me put into context rather why it is that there's significant demand for homes, to own single family homes. And the number one reason that people wanted to buy homes was the flexibility to do whatever I want with the space. Hey, when you come to that age where you start having children and you have animals, you want the freedom to do with that home what you want, to express the type of lifestyle you want for your family and your kids. Stability. I don't want to have to worry about renewing a lease and then having to move next year or having the lease amount go up. No rules against pets. Pride of ownership. Homes typically increase in value. But that was interesting to me. The economic value was one, two, three, four, number 5 on the list. Build wealth, number 6. Tax deductions, number 7. But I think we have to keep in context. We have to understand that primarily people want their own space. They want to do what they want with it. They don't have to worry about getting kicked out. They want to be able to have their family and pride of ownership. And that's important. I think that from a psychological standpoint is important to understand. And another component here about why it is that home prices didn't go down 10% has to do with demand from millennials and from Gen Z. And I've got some specifics on that amount of demand, but just to put this in general context, this is US birth rates by year. It goes back to 1978, which happens to be the year that I was born. But if this number was graphed back to 1978, in fact, back through the Gen Xers, there was a real drop in birth rates through this period of time. And interestingly enough, this is when Roe versus Wade was legalized abortion. The 70s was a period of contraceptives becoming mainstream, and there was a drop in the birth rate from the boomers to the Gen Xers. There was a drop in that birth rate. And then starting with the millennials, you started to see this increase in the number of birth rates per year. And we know that today, the age of a first-time homebuyer has been moved back. It used to be around 30 for my generation. Now with millennials, it's becoming the age of about 38 is the average age. And you can see what's happened here in the last, if we go back 39 years ago, back to 1986, let's just assume we're in 2025 here, because this is the forecast that we're making. You can see that there's this sharp uptick in birth rates. 38 years later, you would anticipate that there's a sharp uptick in demand for housing. And the point I wanted to make here is, look what happens to these birth rates going from 1986 up to 1990. And even there's a little bit of pullback here with Gen Z. So after the millennials to Gen Z, the cohort or the size of that demographic pulls back a little bit. But we're still about 4 million birth rates. Back in my generation, you only had about 3.6 million birth rates. And in fact, this actually bottomed out at about 3 million, a little over 3 million. So you have this strong demand, and that is, and people that want to buy houses for these reasons that are becoming the age of a first-time homebuyer. And that to me is the explanation. as to why we saw 5.9% national appreciation despite 7 and 8% mortgage rates. Now, let's look forward to 2025 if we can, Joe. Unless you have
Yep.
something to add, anything else to add there, or should we roll to 2025?
I'll add in one or two things of that real quickly too.
Please.
Just some
Yeah.
points that you brought up that I want to emphasize as well in terms of supporting the housing values going up. You brought up the birth rates. Yes. It's also immigration, people coming into this country because it's an overall
Great
population
point.
thing. How many people are coming in, let it be born here or coming here.
Great point.
And so that influences it. And then you have the rent because that's like makes rent more expensive. So then all of a sudden it's like, okay, well, renting is just as expensive because all of a sudden if home prices would drop, more people are going to buy because it would be cheaper than renting. And it's like, well, that's not going to happen. That hardly ever happens. And so if the rent prices are up, home prices are going to stay up. So it's kind of just like this snowball effect. And that's why I think that 5.9% appreciation over the last year, it's 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 keeping up there. And then like you showed the chart earlier about places like San Francisco and stuff like that. So for example, San Francisco's landlocked, meaning they can't build anymore. So like you can't build
Yep.
anymore, prices are going to go up, right? So
Yep.
you have limited supply and demand keeps going up higher and higher and higher. Plus, on top of that, you have more people in metro areas like that that are now being required for return to work, back to the office. And so those offices, where they at? So it all starts, supporting it. But again, that was 2024. What are we looking at in terms of 2025? Where are we going?
All right. So great question. So this is another chart that I'll just adding some context here. We're going to get to where we're headed for 2025. But this is mortgage interest rates for 2012 through 2024 and kind of forecasted for 2025. But I thought this was interesting. In 2012, mortgage rates ranged between 3% and about 4%. And then you saw in 2013, rates averaged between 3% and almost 5%. So you can see that these were very accommodative years as it relates to interest rates. 2020 between 2.5% and 3.5%. And then what happened in 2022? Well, we saw inflation drive mortgage rates higher. And we saw mortgage rates go from about 3% all the way up to 7.5%. In 2023, we saw mortgage rates get as high as 8%. In 2024, we kind of saw this range between 6 and really 7.5%, which is kind of where mortgage rates. So this is the counterbalance to that demand that I described in the previous slides. More millennials are becoming the age of first-time homebuyers. Gen Zers are starting to enter the housing market. And so that's the push for demand for housing. The thing that's holding back demand, the other side of that tug of war, is this restrictive interest rate environment that we've been in, which is much higher than what we've seen over the previous decade. All right. So if mortgage rates go down, we would then assume you're going to have more demand from those millennials and the Gen Zers. All right. So what happened during those higher interest rate years? 2022, 2023, 2024, those were higher interest rate years. And you can see by looking at the Mortgage Bankers Association publishes a mortgage purchase application, you can see that in the beginning of 2022, where we had very low interest rates, there was tons of demand for mortgage purchase applications. Those are people that intended to buy a home with a mortgage. And you saw that demand drop in 2022 as rates went up. In 2023, mortgage application data goes down. And in 2024, same thing. Mortgage purchase applications reached their lowest point. I believe this was back in March. Its lowest point since 1993. So crazy. This is a very low demand for housing. And despite that low demand, we still saw appreciation nationally. So that's pretty interesting. Okay. So where are mortgage rates going in 2025? I just want to draw the correlation. As rates went up, the demand for housing went down, which means the inverse is likely true. As rates go down, the demand for housing is likely to go up. All right, so we believe mortgage rates are going down. But the question is, why do we believe that? Let me give you a couple of reasons why. Number one, we think that a lot of the data that we've been getting this year as it relates to the employment market and the strength, the quote unquote strong and resilient economy, a lot of that we believe is based upon an election year and trying to make things look as rosy as possible. So there's different ways to measure employment rates, but there is this thing called the QCEW, which is the quarterly census of employment and wages. This is a very in-depth analysis of the number of jobs that are added to an economy. In fact, there's almost 12 million businesses that are surveyed through the QCEW. It takes a lot more time to do that analysis. In the interim, we get our employment data from something that's called the BLS. It's called the Non-Farm Payroll Report done by the Bureau of Labor and Statistics. And this is only 670,000 businesses that are surveyed. And according to the BLS, there were 2.5 million jobs added to the economy between Q2 2023 and Q2 2024. Well, the initial QCEW report came out last month, and their more robust and in-depth analysis, surveying 95% of the labor market, said, well, we only think there was 1.246 million jobs created. So that means that the BLS may have overstated the number of jobs by 1.25 million. Hey, only 50% off, right, Joe? Roughly 100,000 jobs per month. Now, in February, we'll get the final number. We got the preliminary number last month. We'll get the final number from the QCEW in February. But this is very important because this mortgage rates are predicated upon the future expectation of inflation. If the economy is strong and robust, there's likely more demand than there is supply of goods and services, and that means that there's likely going to be higher levels of inflation. But if that's a BS number and the number of jobs added was only 50% of what the initial reading said, that means that there's not more demand than there is supply of goods and services likely, and that's going to lead to lower inflation, and that's going to lead to lower mortgage rates. Joe, anything you want to add to clean that up? I know that was a little complicated.
No, you're exactly right. So basically, what you're telling us is the government agency that collects the information in a political or an election year inflated the numbers. Huh. Never saw that one coming.
Never happened before. This is a first,
Yeah.
right?
Actually, the piggyback off of that, to again, this reiterates that number is this is real. This is a real number. That 1.2 million is, I want to say it was a year and a half ago. There was a report that just came out that for every one job opening, or for every one person, there was two job openings, and that number is almost down to 1.1. And they're seeing that, and I saw this report. I was reading this report because it's saying how employees like their time or them jumping ship to go to another business is actually dropped off dramatically because businesses are not hiring.
Yes.
And because again, this article that I was reading was talking about return to work and how more people will actually, even though I think it was Amazon or something like that, they had announced that they're doing a return to work starting in the new year, and their employees, like it was something like 40% of them said they would quit. And it's like, no, that number is not going to quit because those 40% are not going to be able to find other jobs.
Yes.
So again, it's the whole demand side of thing, right? So
And the continuing claims, I just saw numbers on this morning, are now up to 1.91 million. And continuing claims mean you filed for unemployment, you weren't able to find a job, and you're continuing to claim unemployment. And then remember, after I don't know what it is, 36 weeks or something like that, I believe, you fall off of unemployment. So that doesn't count the people who have fallen off, but the continuing claims, which are people who are looking for employment, haven't been able to find it, is now at the highest level in 3 years. So we're starting to see cracks in that quote unquote strong and resilient economy.
Yeah.
Yeah.
Yeah. Strong, resilient.
Strong and resilient. So we would assume that that's going to lead to lower inflation and that's going to lead to lower mortgage rates. Just one other piece of the puzzle here to kind of tell you how we came to the guidance that we have for 2024. And by the way, MBS Highway is the source that I subscribe to. Dan and Barry Habib are the foremost experts when it comes to mortgage interest rates. They've been incredibly accurate forecasting interest rates and home values, and they're mentors of mine. And so they provided a lot of these the data for these slides. I just want to give them a big high five and recognition. So, all right, I'm gonna make this very simple, and I'm gonna top line this for you. But as I mentioned before, the factor that most moves mortgage rates is inflation. And inflation peaked and has been coming down. It hasn't been coming down to the Fed's target of 2%, but we believe that we'll continue to see in 2025 lower levels of inflation. One, for the job data that we just showed you, we just talked about, but also because right now the inflation numbers are a bit inflated. And here's what we mean. And there's a couple different ways to measure inflation. Don't get caught up in that. We're going to look at core PCE and we're going to look at core CPI. Just two different ways to measure inflation. Let's not overcomplicate it. So as of September 2024, core PCE was 2.65%, but 18% of the weighting of that inflation, that core PCE inflation measurement, is shelter costs. And because of the way that the shelter costs are calculated, which is in the rear view mirror, looking backwards over the previous 12 months. And remember, you may have signed a lease in 2022 that extended into 2023 and becomes now part of this backward looking measurement of inflation and the increase of shelter costs. 18% of the core is shelter costs. And the way that the government is calculating this number, they're showing 5.1% year over year shelter cost inflation. But if you look at it in real time, based on the CoreLogic rent index, there was really only 2% year over year inflation. So this is a backward looking inflation measurement. Once it catches up to the real time rent inflation, we're starting to see that slow down. We believe that will drag inflation lower. And as inflation goes lower, so will mortgage rates. Core CPI, just another way to look at this. Core CPI, 46% of its weighting is based upon shelter. They're measuring the shelter inflation rate at 4.8%. That's not a negative, by the way. That's just a dash. 4.8% year over year. But again, your CoreLogic rent index is actually showing it's only 2%. So the point is, if you adjust from these higher levels of shelter inflation, the way that the core CPI and core PCE measure, if you adjust that down to the current CoreLogic information, that would show you that you have overstated inflation by about 1.32% because you're looking in the rearview mirror way back. And core CPI should currently be about 2% without the shelter lag. And that just tells me in 2025, these numbers are going to come down. This year over year numbers are going to catch up. That's going to bring inflation numbers down, and that's going to help you bring down mortgage rates. I'm going to move pretty quick through here, Joe. So look, mortgage rates don't move in exact lockstep, but tend to travel with or to follow a similar trajectory of what's called the 10-year treasury. And the 10-year treasury is essentially the government selling a bond. They call it a treasury bond. It's a 10-year loan that you'd be making to the government if you bought one of those. And this just shows the yield. That means as an investor, how much would I make by investing in that bond? Another way to say it is how much would the federal government be paying me to lend them money? And we think that this is going to fall down to about 3.6% in 2025 because of the weakening of the economy, the overstatement in jobs, and the continued downward trajectory of inflation in 2025. So we can see that the 10-year Treasury kind of peaked up here right around 5%. That was in November of 2023. It's been moving lower, up and down, but lower overall since that date. And we've kind of hit a peak and turning down. We think we'll get back down to those 3.6% target. And I'll tell you why that's important, because there's a direct correlation to mortgage rates. So if we look at 30-year fixed mortgage rates, this is actually the spread, the differential between the 10-year Treasury and the 30-year fixed mortgage rate. And if we look back over time, we can kind of run these averages. The spread has typically been between about 1.6 and 2%. That's the trend going all the way back to 2000, meaning that if we have a 3.6% 10-year Treasury forecast, we would expect mortgage rates to be somewhere between 2 and 1.6% above that. But what's happened was these spreads really blew out. In fact, it hit the spread between the 10-year Treasury and a 30-year mortgage rate hit a high of 3.1%. And it is now down to 2.5%. So we think we're going to see two things happen to mortgage rates in 2025. We think that we're going to see the 10-year Treasury trend down towards 3.6%. It's about 4.2% now. So that would drop mortgage rates about 0.6%. But we also think the spread narrows back towards historic norms, which was between 1.6 and 2%. So we think this spread narrows down to about 2.25 in 2025. And that's going to give us a 30-year fixed rate mortgage at about 5.85% for the year ahead. And as we showed, as those mortgage rates go down, we're going to see an uptick in applications and demand for housing. Let me pause there, Joe, and allow you to add some color or thoughts.
Yeah, I like that Treasury market chart. That takes me back to my technical analysis days, and you actually see a perfect trend in it with supports at the high, not breaking through and going down. So all you technical analysts out there, that that's a trend for investment stuff in terms of treasury investments and whatnot. But that's a whole
Definitely.
other topic. Um, all in all, what did you say off the top of your head? What's the average interest rate right now, just across the nation, would you say?
You're running right now in the mid 7% range.
Okay. Um, I'm gonna have you go through any other information you want to touch on real quick, just about, and I'll actually ask you this, in terms of valuations, in terms of housing prices. What do you see, like how much going up? Because like you said, demand's going to be going up. But what have you seen in terms of like, and I know this is tough because it's market to market, but like housing starts, construction type of news, all that type of stuff. And while you're doing that, I'm going to calculate a rough estimate of housing prices just based on the interest rate changing. So yeah, go ahead
Yes.
and share with what you've seen on that.
Well, and let me just correct what I just said. I actually was answering the question, what did mortgage rates average in 2024? Not what they are right at this minute. So let me answer what you actually asked. Right now, the average Fannie Mae 30-year fixed mortgage rate is just below 7%. It's about 6.91, and we think it's going to get to 5.85. So let's call that a 1.05 or 1.1% reduction in mortgage rate over the next year. But they've already come down a pretty considerable amount, right? We were in the high sevens right after the election, and it's come down a little bit over the last month. Now, Joe, tell me that question one more time because I wanted to clean up my previous answer.
Yeah, just going forward in terms of housing price, because I know that we talked
Ah,
about like mortgage rates, but what have
yeah.
you seen on like the housing start side, the construction stuff? Like, what have you seen on that side that would say, hey, like price, this would support prices going up, staying flat, going down? What have you seen there in terms of if
Yeah.
there is that demand increase, what does that supply side look like?
We're starting to see not, the number of homes in the market increase. So if this chart went all the way back to 2010, we would have seen that single family housing inventory peaked almost 4 million, call it 3.75 million. And then it consistently moved, the inventory level moved its way down from 2010 through January 22, which was kind of like the bottom of this peak. And remember, this is the COVID era, right? So massive demand, incredibly low interest rates. Now we've started to see that inventory pick up. And as of November 2024, inventory levels are about 735,000. That's 735,000 active homes for sale, not under contract. So there's different ways to measure this. Sometimes the National Association of Realtors will report inventory levels. I think their report is like 1.1 million right now, but 400,000 of those 1.1 million are actually under contract and will close in the next 60 days. These are actually listed for sale. You've got about 735,000. So you're seeing inventory improve a little bit, which is great. There's more supply for people to choose from. And as mortgage rates continue to go down, this becomes a more favorable environment, greater affordability, more inventory of homes for sale. The thing that's holding back this supply, which was your question, Joe, is that we're only building about 1.4 million new homes a year in the market, and about 100,000 homes get destroyed each year. Fire, they tear down a home to build 3 homes on a bigger lot. Hurricanes, those types of things. So you're really only adding to the supply of housing about 1.3 million a year, and that's not keeping up with demand. Demand is about 1.7 new homes per year. I'll show you a slide on that in a minute. The other thing that's really hampering demand, and you might find this super interesting, Joe, this is outstanding mortgages by interest rates. And so the darker the red, the higher the rate. It's above 6%. The blue is below 3%. And you can see when we went through that COVID era, you used to have 6, 5, and 4 and 5% interest rates as the vast majority, 80% of the mortgages out there. Well, look now, this is less than 3% mortgages. This is 3 to 4% mortgages. This is 4 to 5% mortgages. 80%, pretty much 80% of the mortgages in the country are 5% interest rates or below. That's pretty crazy. So these people are less likely to sell their home and bring new inventory to the market. Again, talking about the supply side is constrained. I'll just show you one more graphic here, Joe, that you might find really interesting, and then I'll let you give us your numbers you were talking about. I'm going to fast forward this here. So look, demographics are destiny. And if you go back, and I'm going to shortcut this explanation for time's sake, if you go back and you look at these different generations, boomers, there was 71 million in that cohort. Gen Xers, 65 million. Remember I said Gen Xers saw a reduction in the birth rate around the time of Roe versus Wade. This was a much smaller demographic, and therefore there was less housing demand. Millennials, 73 million. This is a huge cohort, larger than the boomers, followed right behind Gen Z. These are my kids, 69 million. But even Gen Z is almost as big as the boomers. And these folks are becoming the age of the first-time homebuyer. Remember, the first-time homebuyer age is 38. So what this does is this goes back and this says, look, when the current home ownership rate for boomers is 74%, the current home ownership rate for Gen X is 65%. The current home ownership rate for millennials is 45%. And the current home ownership rate for Gen Z is only 8%. But as these cohorts get older, a higher percentage of them become homeowners. So by time millennials were 30 years old, only 33% of millennials owned a home. But now their home ownership rate's at 45%. And by time they're age 40, the estimate is that the millennial home ownership rate will be 55%. And so when you have increasing demographics, and meaning birth rates, and you have a rising population or percentage that are becoming homeowners, you can kind of forecast what that future demand is going to be for housing. And if we run those numbers, we believe that over the next 10 years, 10 million more millennials will become homeowners based on them going from 45% to 55% home ownership range. And you'll start to see these Gen Zs, the tip of the iceberg will start to become home buyers at the age of 30 here. And so we think there'll be another 17 million from Gen Z. That means you're going to have 27 million potential more home buyers over the next 10 years. But like I said, you're only bringing net about 13 million new homes to the market based on what we've been building of about 1.3 million per year. So this tells me that we're going to continue to have much more demand for housing than we have supply. And then my next slide is an estimate of appreciation rates for 2025. But let me stop and have you comment and share your what your thoughts are relative to that mortgage rate decrease.
Yeah, so again, talking about price appreciation, because I mentioned earlier the back of the napkin like valuation I did, in my area 2 years ago. It was around 2 years ago this time, and I said it was going to be like a 20 to 30% drop. And this again, there's a lot of different numbers that go into price appreciation. And when I look at these back of the napkin things, I just say, look, if everything stays status quo, someone's income stays status quo, the mortgage payment stays status quo because that signals, hey, DTI ratios, this is what people can actually afford to buy.
Mhm.
And all you do is change the mortgage rate, so not supply, because even if you say, hey, supply is going to come in over time, we're not going to have X amount of supply in the next 2 months coming onto the market. Let's just say like that. That's what I typically look at. Where I'm going with that is that if you take the average nationwide, which different reports say different things, but it's about $400,000 is the median home price right now. Okay. And so that would give you a monthly payment on a mortgage of about $2,600. And so if you kept that constant and you drop the interest rate from 6.9% to 5.8%,
Mhm.
based on those same numbers, then people would be able to afford off those same numbers instead of a $400,000 house, $445,000 house. So just based on the interest rate change, I would say along the lines like people would be able to more comfortably afford a bigger house, which drives up the price, and that we're looking just based on that at a 5 to 10% appreciation over the next, year if the projection is, hey, interest rates are going to drop, by 1%. That's typically, what I would say in that range. Um, and again, that's nationwide. Every market's a little bit different.
Of course.
But that's typically what I see. So that segues into obviously what you were saying, like in terms of where you guys are seeing appreciation going. What do you guys see with that, and then so on and so forth going into next year?
Well, it just makes common sense just to validate what you just said. If we saw 5.9% appreciation and we saw about an average interest rate in 2024 of 7.5%, if we're going to go from 7.5 to the high fives, excuse me, and we saw 5.9% appreciation last year, would certainly make sense that we could see higher rates of appreciation in 2025 than what we saw over the last year. And again, that's national. Every market is local and a little bit different. But I thought what would be interesting is to compile what all, kind of like the biggest players in the real estate game, what are they all projecting? And I think these are very conservative, personally. Goldman Sachs is projecting 4.4%, Wells Fargo 4.3%. Moody's and Freddie Mac are down here at 0.3% and 0.6% appreciation. But I thought what was interesting was like none of these big players are forecasting depreciation, meaning lower home prices. Nationally, they're all forecasting higher prices. I'm more bullish than this, Joe. My call, and we'll check how I did at the end of next year. But my call is we see at least what we saw in 2024 in terms of appreciation. I think we'll see at least 5.9%. And that's because I believe that a lot of these numbers are based on the economy and inflation growing based on those BLS job reports. And I think the BLS job numbers were BS. And I think when there's that QCEW final revision in February of 2025. I think a lot of these forecasters are going to do an upward revision of where they think housing values will go, because if the job market is cracking and inflation is going down, then that means mortgage rates are going down, and that's going to bring demand off the sidelines. And I'll just give one more thing for context here. I think this is really important. You alluded to this earlier. If you're moving into a home for its functionality, its utility, and you plan to be there for 5 to 10 years, which most people, unless you're going through a residency program or some intensive training program that's 2 to 3 years, most people that are buying a home have at least a 5 year outlook. And the average number of years in a home used to be 7 years. It's now up to 12 years. Most people are staying in their home at least 10 years. And if you look at any decade, going back to the 1940s, so we've got 80 years worth of data here. You see that during every decade, we saw appreciation. So what this is this shows you the year and then the percentage of appreciation. And this is obviously right after the Great Depression. And you saw 129% appreciation after the Great Depression. The 50s, 36% cumulative appreciation. Home prices increased. 1960s, 23%. 1970s, this was obviously marked with a lot of inflation, right, Joe? So inflation, as you said, pushes home prices up. We certainly saw that in the 1970s with 130% appreciation. 1980s, 77%. 1990s, 30%. Even the 2000s, which saw the longest string of negative housing, 2007, 2008, 2009, down 3 consecutive years. But if you held for the decade, you were still up 66%. 2010 and 2011, 2 down years. But if you held for the decade, you saw 45%. And Joe, I mean, we're just 4 years in the 2020s. One, two, three, four. This would be 2023 data. If we plug in another 5% here for 2024, which is probably pretty safe right now, in 5 years, 5 years, we will have seen 43% appreciation. So we'll already have seen in 5 years about the same amount of appreciation we saw in the total of 2010. So I think this is helpful to give people context. Like, if you're trying to time the market, it's really difficult, and you'd be waiting for a long time to see a string of down years like we did in the Great Recession. Time in the market is more predictive to your ability to create wealth and equity in a home, not timing the market. And last thing I'll show, and then I'll stop sharing my slides. I just found this is really interesting. This is the average net worth of a renter versus a homeowner. And going back to 2019, the average net worth of a renter was 7,300. The average net worth of a homeowner was 295,000. So you were 40 times wealthier in 2019. In 2022, the average homeowner was 38 times more wealthy. And in 2024, this is the final estimate for the last couple of months, so it's probably through the end of data of Q3. The estimate is the average homeowner will be worth 415,000. The average renter will be worth 10,000, and you're 42 times more wealthy. So again, it just goes back to, if you're a homeowner and you're in a home for 10 years, you're building a lot of wealth because you have appreciation and you're paying down your mortgage.
Yep. Yeah, and I'll put on my analyst hat real fast because you brought up a number in there, and this is the first thing that pops into my head in terms of housing prices, support for it going up over time. Is you said that the average holding time for a property is 12 years.
Gone up to 12 years. That's right. Because of that
Correct.
mortgage lockdown, right? 80% of those mortgages under 5%.
That is correct. And so, I hear it all the time. People tell me I was thinking about moving, but my mortgage rate's at 3%. I'm not gonna move. And so for me, when I look at that, I say you have 80% of the market that's not going to move. So that holding time is going to increase. The longer
That's
that holding time increases, that's less inventory, that's less supply onto the market, which means if you are trying to buy the house, you're going to have less supply, which means home prices go up over time.
Yes.
Um, and so that's one of the big things that I look at. One thing I will say on this, because I know we got a comment because I want to say 2 or 3 podcasts ago, you had brought up a slide showing some of the analyst stuff, and somebody pinged me on one of the social media accounts saying, "Why are analysts always wrong? Like, why are these big analysts always wrong?" And I had to tell you guys, like, these guys all work on Wall Street, okay? And so if the average is 2.6, is what they're saying home price appreciation is, you got to be within a range of like 0 and 4 or 5%.
Right.
Because if you're Wells Fargo and that analyst says 4.4% and it only goes up 1 or 2%, you're not that wrong. Consensus analysts were saying similar types of things. You're not going to get fired. If you come out and you say 6% or 7%, and it's 1%, you're going to get fired. So there's a herd mentality on these analyst things, which is why they don't ever really make any money. And the guys that make a lot of money with investments and do it all day, they're doing their own analysis. Kind of like what you were saying, Josh, where like you think it's going to be more than that. You think it's going to be at least 5.9%, based on the numbers. And those of you that are trying to be investors, that's what you got to look at is say, hey, like this is what the typical analyst looks at. Um, what can I do to analyze this more in depth and have better knowledge and better data? And what does that mean? Is it a good time to buy? Is it a good time to sell? I'm not just talking about real estate. I'm talking about like stock market for all you guys, because I know a lot of you have been hitting me up about like option trading and all this other types of stuff. And no, I'm not putting out courses or anything like that. So I'll answer that question right now and all that investment stuff. But yeah, it's that's what I see is the support for housing prices to stay there, to stay where they're at and go up is there. Like the probability of a decrease and stuff just completely falling off the map in terms of pricing. I think in the certain markets that have dropped, they've already done their drop. I don't see any more massive drops going into 2025. Um, Good old real estate, right? Good old asset class. Go ahead, Josh.
No, yeah, you're spot on. And this becomes difficult because we have to talk about national averages because there's so many metros across the country, right? But if generally speaking, if you have all this demand coming from the millennials and the Gen Z that are starting, which is a huge cohort as well, starting to buy homes, and you have a fixed amount of supply, meaning home builders can only bring 1.3 million new homes to market, and you have 80% of the country, as we talked about, that have mortgage rates under 5%. Like I have a 3.75, and we've talked multiple times about moving because we're not in the school district that we want to be in for our kids. But I'm not moving from a 3.75 to a 7. It just doesn't make any sense. And there's
Yep.
a large population of the country that it has that mortgage lockdown effect. Those two things tell me that there's going to be a limited amount of supply coming to market. And the number one predictor for more demand is because we have demographics in our favor, is going to be rate. And I'll just share one last thing. I thought this might be interesting for you to see, Joe. This is just a live chart. It's a little messy here, actually. Let me get rid of these. This will clean this chart up just a little bit here, I think. So this is the 10-year treasury. It's right now at 4.17%. What that means is if I loan money to the government for 10 years on what's called a 10-year treasury bond, I'm going to earn as an investor a yield of 4.17%. That means the government's going to pay 4.17% for 10 years. And then at the end of the 10 years, I get my money back, whatever the amount I invested in that bond. This is the predictor that I mentioned earlier that says, at about 2.25%, and that's about where mortgage rates are. We think that'll narrow down to about 2.25 over the year ahead. But look at this trend line, okay? So we peaked on the 10-year treasury at 5% in October of 2023. And if you just follow this green line down, you see that the yield went down. That means mortgage rates went down. The yield went up. That means mortgage rates went up. And then it hit this trend line, went back down. So what we're seeing is lower highs, Joe, right?
Mhm.
So it's not a straight line, it's a little bit of a roller coaster ride, but these are lower highs. Boom, boom, we hit the trend line, boom, down. We hit the trend line, we broke above it, bam. Now we're back down below this trend line again. And my point with this is if you want to have the best predictor of what's going to happen with home prices, watch the yield on the 10-year treasury. And if this continues to go down and you see it below 4.21, that tells you mortgage rates are going down and there's going to be a lot more demand coming to the housing market, exactly as you just alluded to, Joe.
Yep. Yep. So hopefully that helps all of you looking to buy a house going into the spring. I know that's buying season. That is our housing update for 2025. As always, if you guys need help, I mentioned that Neo Home Loans is a partner of FitBucks. Those of you that don't know my background in mortgages, by the way, I was in the mortgage industry in 2007. And I saw some of the most shady crap I've ever seen in my life. And when I started FitBucks, my original idea was potentially just to launch my own like mortgage broker because I hated uh, what mortgage brokers did, and most of them I didn't feel were educated and shouldn't be there. So there's a reason why we partner with Neo and Josh and his team because they actually know what they're doing, and they're very good at getting you the mortgage that you need. They're not going to just point you into, some square box and make sure that, that they get paid and all this type of stuff. If they do that, let me know. But that is why we partner with them is because they are fantastic. And I know a lot of you guys listening to this are medical professionals. They do have the medical professional loans that are available to you, so you can take advantage of that. Any last words, Josh?
Yeah, I would just say that if you are looking to buy a home in 2025, but you're unsure how to curate your local market data, we have what's called a home report card and a neighborhood report card, excuse me. And I can break down by zip code, by metro, by city, a lot of the information you would need to see how your local neighborhood compares nationally. So, is there a lot of building and a little demand, or is there a lot of demand and a little bit of building? It tells you the affordability of your neighborhood. It tells you how many building permits versus how many renters. It gives you all the data you need to think through what are the supply demand dynamics in my local neighborhood. So, if anybody wants that, just feel free to message me, or you can shoot me an email at josh@joshmettle.com, joshmettle.com, and we'll create that neighborhood report card for you for free, any market across the country at any time. So we're happy to help.
Perfect. As I said, thank you for joining us for the podcast. We'll see you guys soon in the next update.